Hi, my name is Tyler Brand. I'm a real estate developer with Oak Investments, which specializes in commercial real estate assets with high credit tenants on long-term leases. Oak has developed, acquired, and leased real estate properties from small office buildings to large industrial facilities throughout the past 20 years. The following presentation is a capstone requirement or thesis equivalent for the master's program in real estate development at the University of Indianapolis. Before diving into my specific proposal, I first want to give you a little bit of background regarding the industrial real estate warehouse market today. Industrial warehouse sector has become one of the most popular property types in real estate today. Over the past 5 years, the sector has experienced healthy growth while other commercial real estate property types have struggled to sustain demand. Our country's logistics business is quickly becoming a strong force in its national economy, and this is leading to enormous demand for industrial warehouse real estate. The major supply chain drivers, consumer spending, trade, business inventories, and industrial production are all at a record high. Since 2012, the year-over-year rent growth has been positive, and the availability rate has continued to decline. From 2014 to 2018, the industrial real estate market has experienced a net absorption of nearly 1.4 billion square feet. United States inventory has increased by about 75% in the past 3 decades, and nationwide, there's about 14 billion square feet across 258,000 properties. A key theme that I'm sure anyone familiar with the industrial warehouse market has been aware of is the retail versus industrial conversation. The lines of the retail and industrial real estate sectors have been blurred as of late. In the past, the retail sector has had the longest lease terms of all property types, offering investors steady income. The most recent leasing activity shows that the industrial sector's average lease length has climbed by almost 505% in the past 5 years. With more inventory now increasingly stored in warehouses as opposed to the store and brick and mortar, this sector's future occupancy and cash flow outlook has improved. Online retail sales have changed consumer expectations regarding product delivery and have revolutionized how companies move inventory from the business to the consumer. This makes minimizing costs and optimizing speed more important than ever. Obviously, with the current environment, we're definitely seeing these things come into play with the coronavirus. The last mile or locally sourced logistics has driven much of the recent warehouse redevelopment and leasing activity in and around the largest cities in the country. Local regional warehouses and distribution centers are now more prevalent, with same-day and 2-day delivery model as the new norms. A big growth area that's not talked about but is beginning to take shape is in e-grocery and e-pharmaceuticals. A rising share of these are occurring online. Online grocery store sales are now less than 5% of total grocery store sales and are predicted to increase by 4 times to capture 20% by 2025. A main catalyst with regards to the industrial warehouse market is e-commerce. E-commerce sales accounted for 12% of core retail sales in 2017 and were approximately $250 billion. The largest e-commerce company by far is Amazon, and they hold about 25% of the public and private reported online sales. There's a number of other companies, eBay, Apple, Walmart, Home Depot, Wayfair, Best Buy, Costco, Macy's, and QVC that also rank the highest after Amazon. By 2030, total online sales are expected to be about $1 trillion, or roughly 32% of total retail sales. With every $1 billion in new commerce in new e-commerce sales, equating to about 1.25 million square feet of new warehouse demand. An estimated 240 million square feet of new space will be needed for e-commerce alone in the next 5 years. Now let's take a look at my specific proposal. The speculative industrial development opportunity is located at 475 East in Lafayette, Indiana. This development will provide more supply to Tippecanoe County's growing warehouse market. The total site that I'm looking at is 50 acres, but the initial purchase will be just under 23. I'm proposing a facility that is approximately 305,000 square feet of Class A general distribution space. The target cap rate upon stabilization or yield on cost going in is 8.5%. We're budgeting a total project cost of approximately $56.41 per square foot and underwriting rents of about $4.79 per square foot triple net. Net operating income is slightly under $1.5 million. The total project cost is a little over $17 million. The development itself will be financed initially with a 70% loan to value construction loan, which will take approximately 12 months. Total equity for the development is about $5.2 million. This deal has a structure where the general partner will put down 10% of the equity, with the limited partners contributing the remainder. There will then be a waterfall structure for distributions with the 10% pref and all profits above being split 50-50 between general and limited partners. The development will be speculative in nature, but there will be an aggressive marketing plan to secure a tenant prior to construction and then throughout construction in the 2 years that follow. The general and limited partners will finalize the exact construction date, as it will depend on various market factors. Construction will take approximately 12 months, and then the following 24 months will be rolled into a mini perm debt structure. This essentially gives our project about 36 months to get leased before we have to begin servicing debt from the cash flow. One thing I'd like to point out here before we move on to the next slide is the sensitivity analysis at the bottom right. If you're looking at the top part of this chart, you see right here the $4.79, which is the triple net rent that I underwrote. It doesn't make sense for me to look at anything above 4.79 because those are only better case scenarios. There's a quote that Sam Zell says where he says, "I'm only focused on trying to figure out what the downside is." And the sensitivity analysis allows me to basically determine what our return on cost will be if we don't happen to hit the lease rate that we are underwriting. Now also, say our project comes in over budget on a per square foot basis. I also included that along the y-axis of this chart to kind of show you if it is more expensive and we have lease rates that are a little bit less than what we thought, what does that do to the yield on cost? And you can see that. Moving on to the next slide. Now we're going to dive even further into this specific proposal. It is a general distribution warehouse facility that is Class A. It's just under 305,000 square feet. This will be tilt wall construction. We're reserving an option to potentially do precast, but due to the longer time frames with regard to ordering that product, tilt wall seemed like a more viable option, but that's a dynamic conversation that we're having with various GCs to determine what the best course of action would be there. It's located right near I-65 off of the Dayton exit. It's also close to 52. The building itself will have a sophisticated sprinkler system, LED lighting with motion sensors, up to 10,000 amps of power. There will be a small office component, probably about 5% of total rentable square feet of the building, but it will depend on what the tenant is requesting. A lot of the buildings nowadays are going to larger clear heights. In the past, a large clear height was considered 26 to 30 feet. Now, 36 feet and above is basically the norm for new product coming online. So this particular project will have a clear height of 36. The docks are expandable to 72, potentially more. Drive-in doors, we have 4, but those can also be expanded. And then the column spacing is 50 by 55 feet. And there will be a total of 250 spaces for trailers. Now to the site overview. As I mentioned, the gross area of the site is about 23 acres. The rentable area is just under 305,000 square feet. There's about 205,000 square feet of green space. A guy by the name of Mr. Rowe currently owns the site. I've begun having conversations with him via broker, and we're getting an idea of where it would make sense to purchase the ground as far as a dollar amount per acre. But it looks like there will be an opportunity to acquire the ground at a price that makes sense in terms of the feasibility of the development. Moving on with the site overview, these are just some pictures showing what the site looks like currently today. As you can see, it's being used, or was at one time, as farm ground, cash rent. So the top picture shows a panoramic view from the north side of the site facing south. The bottom left is the northeast corner of the site facing southwest, and the bottom right photo shows the northeast corner, which is at Haggerty and Veterans Memorial. History of the area. Greater Lafayette area is one of the fastest growing communities in the Midwest, and it's located in between Chicago and Indianapolis. It is the proud home of Purdue University, SIA, Wabash National, and many other great manufacturers, high-tech firms, and small businesses. Greater Lafayette has more people employed in its workforce than ever before. It provides the advantages of a large metropolitan area with the conveniences and quality of life of a smaller, more comfortable community. As you can see on the bottom, there's a number of different companies there located within Tippecanoe County. A lot of them are actually foreign companies, and Greater Lafayette happens to be a hub for foreign direct investments, as many companies from around the globe call Tippecanoe County their home. The draw stems from partnerships with Purdue University, the ever-evolving technological advancements in manufacturing, and the great quality of life this community provides. This is a trend that should continue into the future, and one that we factored in to our speculative industrial development proposal. As you can see here, this is a quick snapshot of the history of the area via Google Earth. So I'll start up in the top left and show you. You can see here where our site is. And this road coming down here, if you're following my mouse, is Veterans Memorial. That will then run over here to what's called 350 South. This area right here is 52. And then over here is the I-65 Dayton exit. Right here is Subaru. And then basically the past 15 years, this area right here along Haggerty, and then this area right here along Veterans Memorial over to 350, and then south of 350 and 52 has all been developed significantly over the past 15 years with regards to industrial warehouse product. As you can move here, 92 to 2006, you can kind of see this is beginning to get built out. 6 years later in 2012, the trend continues, and then 2018, you see kind of where we're at today. The site is currently zoned I3, which is industrial, so there will be a minimal process with regards to entitlements. Our it should be a relatively smooth transition to begin starting construction after acquiring the site. This phased land use plan, I pulled this from the comprehensive planning website of Tippecanoe County. As you can see here, this darker area is all industrial, so that's our site is located in there. Now onto the market analysis. Regionally speaking, Indiana is the best state in the Midwest for business and is ranked number 5 in the country. Indiana is one of only 15 states to earn a AAA credit rating from all 3 agencies, and it's known as a crossroads of America. More interstate highways converge in Indianapolis than any other city in the U.S. The Hoosier State ranks in the top 10 in 46 logistics categories, and Indiana gets high marks for transportation, infrastructure, cargo movement, and a number of companies in all modes of freight transportation: truck, rail, air, and water. Indianapolis is also home to the second largest FedEx hub in the world. This slide here shows the supply of other industrial warehouse product that is either tilt wall or precast within the Lafayette area. There are a number of other smaller buildings, usually under 100,000 square feet, that have a steel facade. That is a different type of end user than what we are looking for. We're looking for a little bit larger tenant. As I mentioned, our particular building will have the ability to be divisible into 75,000 square foot bays. So essentially we could have 4 different bays and 4 different tenants in a 305,000 square foot building. But we'll just kind of run through here real quick. As you can see, starting at the top left, Park 350 is a great example of a building that was developed shortly after 0809. It took a little bit longer to lease up, but they built the initial 150,000 square foot first, and then added on remaining 150,000 square foot in the second phase. 307 Logistics was developed in 2005. That's a 500,000 square foot facility that does a lot of work with Wabash National. And then you can see some of the newer buildings that have come online. The Old Dominion facility, which is very close to our site. Caterpillar, 310,000 square foot facility that Ambrose developed and later sold. And then the Toyota building was developed in 2009, and that's also near my site. Really, all of these buildings are within a mile radius of my site. But these are essentially the only precast or tilt wall competitors from a supply standpoint in the area. Moving on, the following shows current lease rates of industrial warehouse buildings in the Lafayette area that have space for lease, and you can see that those rates range from $4.69 to $6 per square foot per year. Some of that is triple net, some of that is gross, but as you can see, what I underwrote with regards to my financial model is conservative relative to where the market is currently at with lease rates in the Lafayette area. In summary, as I mentioned, Tippecanoe County is home to Purdue and essentially is an insulated economy with the number of different companies and industries it has within it. So whenever there's a economic pullback across the country, Lafayette tends to have some protection there, and they're insulated from an economic standpoint. I want to touch on one point here. Within Indianapolis, there is more than 9 million square feet currently in development, and that was as of August 2019. Majority of that being speculative in nature. Just to get an idea where things are trading at, 6 acquisitions closed in the first quarter of 2019. 5 involving warehouse and distribution product at an average sales price of $71 a square foot. I'll circle back to that as I underwrite, or as I show you how I underwrote our exit assumptions. And you also see that $71 a square foot is what falls in line with where the Toyota building was sold recently in Lafayette, Indiana, which is a very similar building to what we will develop. Here's just a quick snapshot of what's called a SWOT analysis that essentially dives into the strengths, weaknesses, opportunities, and threats of this speculative industrial development. In summary, some of the strengths are that this is a great site location. There's currently a low supply in the area of precast or tilt wall product, and the market is still developing. Some weaknesses are that this market is much smaller and more niche than either the Lebanon or greater Indianapolis area. Over 300,000 square foot coming online at once is a speculative development, may take multiple years to stabilize. So there's a number of ways to think about that. One of them could be to build 150,000 square foot initially and then build out the remaining 150,000 square foot in a second phase, but that's a dynamic conversation that will be a function of conversations we have with potential tenants. Opportunities out there are continued demand from e-commerce and logistics. As I mentioned, the relationship between new e-commerce sales and the fact that we need industrial warehouse product for those e-commerce companies to store things. We're really only in the second or third inning of that. So when you look out the next 10 to 15 years, there's significant opportunity to capture those types of users. Then you throw in the logistics companies. FedEx is already in the area. They have a trucking facility just down the road from our site. And then another area that's going to take shape, the grocery and pharmaceutical delivery. Threats are other new tilt wall or precast facilities that are going to come online. TM Crawley is developing one. They're the ones that developed the Toyota building that was sold to Monmouth. Another threat would be the cost of capital would increase with higher interest rates. Construction costs may increase, and that may make our total project budget higher, which would reduce our yield on costs, assuming the lease rates aren't increased. Another way of looking at the fact that TM Crawley and some other developers are coming in and building a similar product in the area, to me it means that the demand is there and the supply is such where there's a significant opportunity. And I truly believe if you build it, the tenants will come. And Lafayette is really in the early stages of where, I think 10 to 20 years from now, their industrial warehouse supply or inventory will look very similar to how the Lebanon area or the Whitestown area kind of grown. And I'm not saying to that level, but I think there will be a significant increase today or 10 years from now. And I think you'll have a few facilities that are larger than what we currently have, i.e. a 500,000 to 1 million square foot facility. On the planning and design, as I mentioned, this is a general distribution warehouse facility, about 304,000 square feet, divisible to 75, tilt wall. And as you can see, I kind of touched on all these earlier, but it's from a technological standpoint, this building will be as sophisticated as possible without sacrificing project cost and inflating costs and things. But we're looking to have a very sophisticated building, and it will ultimately determine what our end user is looking for. Here's a few renderings of our building. This is a bird's eye view from the southeast corner of the site facing northwest. This picture is a bird's eye view from the southeast corner of the site facing northwest. This is just a quick snapshot of our development timeline. Obviously, this is a moving timeline, but we will essentially leverage Microsoft Project to keep track of our project. And when we work with GCs, this will allow us to really dive into their budget, their timeline, and those types of things. All right, on to the financial analysis, which in my opinion is the most important part when analyzing this speculative industrial development. There will be 305,000 square feet of rentable space on this 23-acre site. This is essentially a 31% net rentable square feet ratio. The development will be supported by a 10-year tax abatement with a 10% decrease per year over the term. Total project cost is a little bit over $17 million, which is $56 a square foot. Return on cost that we're targeting with our lease rates and project cost is 8.5% once stabilized. This is net operating income of about $1.46 million, and rent on a triple net per square foot basis is $4.79. Total equity for the project will be $5.2 million, which is 30%. And the project will be funded by a construction note at 70% loan to value of appraised value. Limited partners will come up with 90% of the equity, with the general partners contributing the remaining 10%. Limited partners will receive a preferred return of 10%, and any distributions over that threshold will be split evenly on a 50-50 basis between the sponsor and investors. I mentioned construction will last approximately 12 months and will transition to mini-perm structure. That 36-month timeline, which is a 12 months and 24 months of mini-perm, that combined timeline is essentially the shot clock that we have to make sure we get the lease signed before we have to begin servicing debt from the cash flow. As I mentioned earlier, the Sam Zell quote of focusing on the downside, I don't pay attention to what our lease rate is or the returns on the lease rate are if they're above what I'm underwriting. I only care about worst case scenarios. Here's a quick snapshot of my assumptions. I won't get into too much detail here just for time purposes, but as you can see, my financial model was essentially, I believe it was 5 tabs, beginning with assumptions. It's sources and uses. You can see on the right, it's kind of expanded out in the particular items with regard to our construction, total hard costs, total soft costs, and then coming out to total project costs, where you can see the sources of our project from a debt and equity standpoint. And then we're getting a tax abatement as well, which will help the feasibility. Here's a 10-year cash flow analysis. I basically modeled out a 10-year cash flow based on the project being stabilized. I did a sale in year 5, and there's a 100 basis point spread between the going in cap rate and the reversion cap rate, which is the sale. I did a waterfall, as I mentioned, so here's a snapshot of the distributions. Regarding the sale, as I mentioned, the going in cap rate for spec development is 8.5%, and our sales cap is 7.5%. This is based on a conservative exit assumption of 100 basis points over our going in cap. The financial model showed a sale in year 5 at a sales price of just under $23 million, which is equal to $74 a square foot. Project level return metrics are about 28%. For the IRR, cash on cash is about 18%, and equity multiple is a little bit over 3 times. One very significant point that I think really makes this speculative industrial development attractive is that there are a number of REITs that have owned industrial warehouse properties in Tippecanoe County. The above exit assumptions model this similarly to the past sales to REITs in Lafayette. So there's 3 main transactions that I want to point out. The first being the Stag Industrial, which is a publicly traded REIT focused on single tenant industrial properties. They own 3 general distributions in Lafayette, which have footprints of 71,000 square feet, 120,000, and 275. The difference between their facilities and mine is that they have a steel facade and they're located more off Kepner and McCarty, which is a little bit different area than where some of the precast and tilt wall are going up. Monmouth, which is one of the larger, older public equity REITs in the world, also specializing in single tenant and net leased industrial. In July of 2019, they acquired the 350,000 square foot facility that T.M. Crawley developed. That lease was a 10-year lease to Toyota. Obviously, that building is right across from the Subaru Isuzu automotive facility. From a valuation standpoint, this transaction traded at about $73 a square foot. Rent was about $488 triple net with a sale cap rate of 6.8. So obviously the developer made money on that in that they developed it on a lower square foot basis than what they sold it at. And there's actually a pretty significant spread there relative to other income producing assets. Thirdly, the Lexington Realty Trust, they own diversified portfolio and single tenant net leased. They own the Caterpillar building, and that was built in 2017, and it's about 309,000 square feet of rentable space. So the fact that 3 REITs have owned properties in the Lafayette area really speaks to what others outside of our market think of our area with regards to industrial warehouse real estate, and I think it's very exciting. This is another tab that I included in my financial model. It's just an IRR matrix showing the levered returns, both the IRR and equity multiple, and it shows just different holding periods all the way out to year 10. In conclusion, the speculative industrial development proposal is one that is largely based on math and economics. The relationship between the triple net rent and cost to build to the total return on cost allows an investor a significant margin of safety. The developer will then have built-in risk mitigation against a longer lease-up time frame, a higher total project budget, and low market rents at the time of leasing. Due to the growing demand for warehouse space in Tippecanoe County and low existing supply of tilt wall precast product, this allows an investor to capture a yield in commercial real estate that is more attractive on a risk-reward basis relative to other property types. The first step in this transaction is to get the ground under contract. Construction start date can then be fluid until a lease is signed to reduce risk of an extended lease up. The warehouse could either be sold as vacant or once it is stabilized. The optimal scenario would obviously be to have a lease signed prior to construction. Rather than develop approximately 300,000 square feet immediately, the developer may choose to construct half at a time, with the remaining 150,000 coming online after the first phase is stabilized. In conclusion, the conservative underwriting assumptions, flexibility with construction and lease up, and the potential exit sale to a REIT or larger institution makes the speculative industrial development commercial real estate opportunity worth exploring in more detail. I'd like to thank Eric Harvey, the program director at the University of Indianapolis, for the Masters in Real Estate Development program. I'd like to thank all the professors of the 10 classes throughout this program. The Masters in Real Estate was a great use of my time to get better at the craft as a real estate developer. Feel free to reach out to me if you'd like to learn any more about this product. My cell is 765-426-9645. If you'd like to discuss this in more detail with regards to this particular deal or really any commercial real estate investing opportunity in general. Thanks for your time.